Hello, everybody. My name is Carol Bulman. I'm your host for Conway Conversations this evening. I'm the CEO of Jack Conway, and we're thrilled that you'll be joining us for this really important topic tonight. The timing could not be better for our topic. We will be talking about mortgage interest rates and how they affect the current market, how they affected the past market, how we're seeing the market be affected in the future. So we have a lot of information to be shared tonight by three amazing experts. So I'm going to jump right in and introduce our three speakers. So starting with James Solimini. James Solimini is from Guaranteed Rate Mortgage. James is one of the top loan originators and vice president for Guaranteed Rate. If you haven't heard of Guaranteed Rate, they are the #1 lender in the United States. I'm sorry, #1 lender in Massachusetts and #2 lender in all of the United States. James is committed to helping homeowners with home purchase loans and refinances while simplifying the mortgage process, which is a fabulous thing. He brings his expertise to several offices here at Jack Conway, and we welcome you, James, to the conversation tonight.
Thanks for having me, Carol.
Thanks. We also welcome financial advisor Henry Wheelwright. Henry is the executive director and founding partner of Griffith Wheelwright Group of Morgan Stanley and a good friend of Jack Conway Companies. Henry, along with his 5-member incredible wealth management team, provide financial planning and investment solutions to families and businesses, both locally as well as across the United States. So welcome, Henry. Look forward to hearing from you.
Thanks for having me. Looking forward to it.
And from Jack Conway, I welcome Robbie Lindo, top sales agent and broker with over 25 years of experience. Robbie is a member of the Jack Conway Hanover team. Prior to joining or rejoining Jack Conway, Robbie founded his own boutique real estate firm right in the town of Abington, and he grew that to be a successful firm providing fabulous service. Together with the power of Jack Conway, Robbie's clients receive extensive resources and great visibility while maintaining top-notch and personalized service. I found that on your website, by the way, Robbie.
Yeah. Oh, all right.
So we're going to jump into this topic. And like I said, the timing is absolutely perfect because we received some good news out of the financial markets. I'm going to start tonight with James to give us a little bit of background of what rates are doing right now and a little bit of the why behind them. James?
Yeah, absolutely. Well, it couldn't be better timing, like you're saying, with every week, every month, reports come out that the market reacts to. And this morning was the CPI report, which is Consumer Pricing Index. It's basically the barometer on the inflation in the U.S. economy. So how we can tell what inflation is doing across the country. And it came back lower than expected today, which the markets reacted really well to, driving the bond market in a positive direction, which brought rates down. So we're seeing the average rate in the country right now at 7.4%. Down from over 8% a week or two ago. So it's a really, really great move for rates for us, and it's great for homeowners right now.
Great. It's been a really wild ride for mortgage interest rates this year, right, James? We hit an incredible high, and when was the last time we had these types of rates?
So we're seeing rates at the levels that we've seen, or the highest levels in over 24, 25 years. We saw a really quick rise. Rates were down in the high 5s, low 6s back in May or June, and they shot up to 8% very quickly. So it was a pretty shocking and a very stressful roller coaster ride the past couple of years, specifically this year as well. So rates have really been all over the place. So it's nice to see us kind of getting to the top of the mountain and coming back down.
So this is good news.
Yeah, absolutely.
Absolutely. And with every good news, we have opportunities for our buyers and sellers. And that's a lot of what we'll talk about tonight, which is great. Thanks, James, for starting us off. Henry, could you provide us from a financial services perspective or as a financial advisor, some of the background, the whys to the interest rate? Why did we have this astronomical rise this year compared to the years before? And what do you see in the future?
Yeah, great question. And obviously just grateful to be part of the discussion this evening. It's a large question that really, I think, centers on the response to the pandemic and a good understanding of what's happened with money supply. Many of you who are watching this program hear the name the Fed, the Federal Open Market Committee. And just for a little bit of background, that's a government organization that goes all the way back to 1913. There's really tasked with two main mandates for the American people. Maintaining interest rates and money supply in a manner that keeps gainful employment, unemployment ideally around 4%, and inflation, as James mentioned, often measured by core CPI, around 2 to at most 3%. And if you look at what has transpired with the Fed over the last few years, you can answer that question. The Fed had gone from a period of stimulating the economy through bond purchases and reducing overnight lending rates to zero during March of 2020, when we were all at home and disjointed by the pandemic. All of that money supply that, albeit not only came through the United States, but all over the world in the trillions, combined with supply chain difficulties from the pandemic, led to 70s-like inflation. Again, I'm in my mid-40s, born in the 70s, but you'd have to go all the way back to the early 70s and mid-70s to see inflation rates in the 9, 10, in some cases 15% range for those on this call that remember it. Just over a year ago, we had 10% core CPI, and the Fed has been on one singular mandate. Employment's been strong, but inflation's been high, and they've had to raise rates, the overnight borrowing rate, essentially from 0 to 5.25. If you measure that by 25 basis point rate increases, that would be 20 rate hikes in a very short period of time. Those that have followed not only the housing market, if you followed the equity market or fixed income markets, last year was one of the most challenging years in 50 years for stock and bond investors. All a reflection of this rapid rise to fight inflation. James talked about today. It was a great day in my world for my clients and those that are looking for investment advice and counsel from my team. What have we seen over the last 2 weeks? 2 best weeks in the equity markets and a significant decline in the 10-year treasury. Mortgage rates often pivot off the 10-year treasury. The 10-year treasury just over a month ago eclipsed 5%. It had been multiple decades, as James alluded to, since rates were up over 8% in the mortgage market and up over 5% in the 10-year treasury. Today, off the CPI news, combined with a feeling that stimulus will come into this market, that support for the economy will be the mandate, not inflation, caused the 10-year treasury to drop under 4.5. So I'm very optimistic, but it's important for people to understand rates are moving predominantly off bond purchases and money supply, and also moving off overnight rates that are really designed to push and pull on the economy. Right now, they've been pulling liquidity to fight inflation. Ultimately, I believe next year you'll see they'll be pushing liquidity in, good for lower rates, good for risk assets like housing and real estate.
That was an incredible description. And thank you so much for walking us through that, Henry, because this is news that our buyers and sellers are really waiting for, is some type of downward movement. Robbie, I'm going to move over to you now. How will your clients, your buyers and sellers, feel about some type of movement going down? I don't think people are necessarily looking for 2.5% or a 3% interest rate, but they're looking for some type of movement going in the different direction. Do you agree with that?
Yeah, for sure. You will have, you got some of them out there that are saying to me, well, should we wait? The rates are going to go down. Like what? Like, do you think it's a good time to buy? And I have been saying to them, look, it's still pretty active out there. It's still very active. You can, I'm not going to say it's not like it was maybe a year ago or the summer of 2021, 2022, where you're competing with 30 and 40 offers. Okay, but we're still having multiple offer situations. Okay, let's say 10 or 12 offers, but what I have been finding, it's typically in the low, the entry price range, depending on the town that you're in. Okay, I'm finding it to be a little slower in the higher price ranges in the towns that you're in, but the lower price ranges still very active, still multiple offer situations. And so I've been telling them, if you're going to wait, if you're waiting and you're waiting for the interest rate to drop, like some of these other people, it's going to go from 10 to 12 to 15 offers back up to 30. So I think this is a great opportunity for them to buy right now. I'm a believer in that. And, it goes down to very simple fact of supply and demand, right? I mean, at the end of the day, our housing supply is still not up to pre-pandemic numbers. Okay. So like there's not enough houses out there for people to buy. So if you have this many buyers and only this many houses, I mean, you're fighting a lot of people until we see, I feel like until we see the rise in supply, it's regardless of the interest rate dropping now or later, it's better to buy now.
All right, so there's a lot of really important points that I want to dig into a bit that you just mentioned. And let me stay on the buyer side of the transaction for a moment. And then I want to talk about sellers, because there's a very interesting supply and demand issue that's going on there that interest rates dropping may assist with. So James, what are some ways, so if I'm a buyer and I'm a customer of Robbie's and I've been out looking for a home and I have been up against many other buyers looking for homes and I've been outbid, okay? So, but now there's less people looking for homes, as Robbie said, because of the interest rates. Is that necessarily bad? As Robbie is saying, it might put them in a little bit better position. What I'd like to know from you from a mortgage perspective is, how do you assist those people that Robbie has been helping for 2 years that have a little bit higher interest rate as far as affordability goes?
Yeah, so there are a number of programs out there that are helping affordability, from first-time homebuyer programs to temporary buy downs, permanent buy downs. Right now, if it's not as much of a seller's market, more of a buyer's market, where the buyer has more of the upper hand, able to bring back contingencies, have inspection contingencies, or maybe ask for closing cost concessions, a concession to do temporary buy downs or permanent buy downs. These are things that you can do now when there's less competition. So affordability is the number one reason why people are not in the market right now. So to Robbie's point, buying right now is advantageous strictly from a financing perspective. If you look at the reason why there's less out there right now is less people can actually afford this market. So if, in my opinion, and from a financing perspective, again, if you can afford this market, or if you know you're going to buy within the next year, right now is better, because when rates come down, more people can simply afford it and you'll have more competition. So the people that are on the sidelines right now because they simply can't buy, that's all well and good. That's fine. You're waiting for rates to come down so you can now afford it. Then you can throw your hat in the ring. But for the people that are waiting because of just being able to have a better budget, now when rates come down, you're going to be in a ring with a lot more hats, right? So you're going to be competing against a lot more people. So the better way to look at it in terms of affordability is, if you buy a property now and the rates are higher, you might have to budget a little more intuitively, right? You might have to take the higher rate than you want to. But in the spring, like Henry was saying, if rates come down, which those are the projections our rates are going to come down next year. We don't know how much, we don't know when, we don't know how. But with all of the economic data that comes out and rates are going to come down, now you have more people able to afford it. You have more competition and you'll be paying more for the same house. So if you're getting a house now, you're not worrying about falling in love with a house in the spring and at a better interest rate and overbidding for it just to get it. At that point, now you're just refinancing the debt on the property, and you'll probably have more equity because prices are going to go up. With more competition, prices will continue to go up. So from an affordability perspective, it's really the concessions that are the best for right now as a buyer's market. A buyer has more control than the seller. If the seller is looking to offload their property, you can offer with a concession saying, hey, give me $10,000 for a closing cost credit or a temporary buy down, things like that. So it's simply the affordability is the number one thing that I think is advantageous for people right now, because I'm a big statistics person, as you know, right? So if we go from for every 1% the rates come down, you have another 5 million buyers that are able to enter the market in terms of affordable average prices. So rates go from 8 to 7%. Now you're competing against that many more people. So it's better to be able to at least get into the market sooner if you're able and you know you're going to in the near future.
Okay, let me summarize some of that because this is a really important point. You came from the same, very similar direction as Robbie did, saying that, yes, rates have gone up a little bit or quite a bit over a short period of time. They're starting to settle back right now. There are some people that because of rates, they cannot afford the same mortgage any longer. So they might be on the sidelines, all right? But the people that can afford should jump in because if they wait till the rates drop next year, according to Henry, they are going to have that much more competition and also values could be higher. Is that correct?
Right, absolutely. So if you compare it to, let's say that, and when we look at, talk about inflation, we talk about home prices increasing. We saw prices increasing at a clip of 15-20% through COVID. It slowed down, but still prices are going up. So if you bought it now and the rate was 7.5%, now when you refinance that property, you're going to have more equity because the house next door is now selling for more money, and you'll be able to refinance the debt on the property. So to your point, and the statistic is when rates were at 3%, there were 50 million eligible buyers in our country that could afford the average home in the United States, 50 million. At 8%, that number dropped to 22 million. Right, so there's 28 million people there that were priced out simply from affordability perspective. Now, every 1%, if you do the simple math there, for every 1% that rates come down, that's another 50 million. So as we see rates come down, more people get excited, more people are willing to sell their home, more people are looking to buy, and you have the people that didn't necessarily need to buy, but now they can make a lateral move or they can downsize or whatever it is. You're going to have more people in the market.
Okay, great. One thing I neglected to mention, our listeners, if you have any questions, feel free to type them in the chat, and time allowing, I will pose the questions to our experts. James, you talked about concessions, buy down some products. I'm going to come back to those in a moment. But first, what I'd like to do is go over to Henry again. Henry, you're working with a lot of customers, clients who utilize investment interest on savings and other investment vehicles to qualify for mortgages, or maybe they're taking cash out of some of their investment interest mortgages. So when you see rates go up, is there actually an opportunity for some of those clients?
Yeah, I think it's a great question. And then I want to double back as well, Carol, on something which is what could cause rates to come down. So maybe we should shelf that because I think that's important information for the audience. The first is the silver lining has been money markets, savings rates are at decade highs, right? Institutional money markets for our clients that we use day to day with no risk and liquidity and no fees are paying 5.3 to 5.5%. Those, and I don't want to step into James's world, that have been through taking clients through the underwriting process through mortgages and debt to income ratios and assets that are held outside of qualified accounts. Simply put, the more capital you have, the larger income streams help that affordability, right? So that's the basics. The opportunities have been outside of risk assets or stocks per se. You can have guaranteed interest rates that are comparable that really grow wealth. So that's a financial planning discussion. I think what's interesting in our world of wealth management, as the affordability, as James talks about, is maybe priced out some of those 20 some odd million people, you start to see different types of lending, pledged assets from parents, isolated gifts in which need to be documented. And there is some taxation, if not at appropriate interest rates. There's been an opportunity as financial planners to work with folks like James, like Robbie in the real estate lending world to try to come up with a strategy to get the client in the home and potentially refinance the property or make it more affordable. So I think that's one of the messages that I stress this evening is, make sure your clients or those that you're educating about the process are pulling in financial planners, tax accountants, and good counsel, because sometimes there's overlooked strategies to make it work. And somebody like James can say, yeah, we can get that done. Rates, and this is why I think, Carol, I wanted to pivot and kind of take a question that wasn't posed. James talked about the 1% and what it means. So, first let's understand where rates are. Our overnight rate is 5 to 5.25 from zero, right? We've had, as I said before, in essence, 20 rate hikes. What would cause 1%? What would cause the Fed to start cutting rates, or would there be other factors? There's a bit of good and bad news here. As I mentioned, it's been a unique situation to fight inflation. If in fact the economy slows, and it is slowing, we're not going to have a recession, that's not on the table right now, but potentially if we see economic slowdown in spending, retail sales, you're going to see typically at the start a 0.5 point cut, a 1/4 point cut. And a projection by the Fed funds rate, essentially where we're predicting things, is somewhere around 100 basis points, 1% of Fed rate cuts by this time next year. So that's just good information if you correlate that to what James says. The second aspect is, again, a phenomenon that may be the ideal world. In my world, we called it the Goldilocks scenario, something that's great for all risk assets, where the economy is still growing, inflation comes down because supply chains are working, the labor market and participation rate is really strong, and you're trying to match the overnight rate with GDP growth. GDP growth ran for a decade at roughly 3%. We're at 5.25, right? We had a GDP reading just a few weeks ago at 4.9. We're expecting GDP to run at 2.5% next year. If the Fed were to operate under normal conditions with normalized inflation, you could see a scenario over the next 2 to 3 years of 2 to 2.5% movement. Take that same math to James and take that same scenario that Robbie talked about, competition, you can make a case for it. So again, hated to pivot, Carol, but I think it was a missing question, which is, okay, when and how much and what would be the catalyst?
That was very important. So what you're saying is we're here now. We can expect the rates to come down next year under the circumstances that you talked about. And you talked about refinances, and we have a question in the chat about the refis. And I want to come back to James on that, because if I'm a buyer and I'm saying, I really want to jump in right now, or I have to jump in right now. I mean, there's situations that drive us to purchase a home, good things and bad things. How easy is it to refi, James? How are you counseling your clients?
Well, in many cases, it's a lot easier because you already own the home. You're not worried about moving trucks and making offers and timelines and things like that. You're already in the property. So, but the thing to understand is a refinance is a new mortgage application. So you have to still be employed. You have to still have good credit scores, things like that. But in general, it's a lot easier because we can, in most cases, within a year, we can use the same appraisal unless you want a new one. But we're not factoring in a purchase contract. So we'll just get, depending on the scenario, updated pay stubs, bank statements, mortgage statement, and we can run it through underwriting. And in general, we can close refinances in a couple of weeks. So it's also a lot cheaper to refinance if you decide to pay the closing costs. In many cases, I'm having a lot of conversations about refinancing now. I'm sure you can imagine that. Every client I'm talking to, every client that's closing right now is saying, well, if and when we can refinance, what does that look like? What I like to do, I like to call it ride the wave down. So let's say that rates are going from, we were at 8%. Let's say we can get a rate at 6%. But what we'll do is a no closing cost refinance. So we're talking about cost. The average closing cost scenario is going to be anywhere from $3,000 to $3,500 for actually closing. Anytime you do a mortgage, there are costs of doing the mortgage, appraisers, attorneys, lenders, things like that. We can do a no closing cost refinance by doing a lender credit by giving a slightly higher rate than the actual market rate. So say it's at 6%, but you can get 6.25, and we pay all the closing costs for you. So at that point, when I look at refinancing, we're looking at your break-even point. What's your return on that investment? If it's going to cost you $3,500 and you're saving $100 a month, simple math, that's 35 payments for that to pay for itself. But if we can pay zero closing costs, your return on investment or your break-even point is day one, right? One payment. So as rates go down, if we're going to ride the wave down, we can keep doing no closing cost refinances, and the client doesn't have to worry about leaving money on the table. So the refinance is a new mortgage application, but it's actually easier than going through a purchase.
And to run through that scenario and all the details of that, a phone call to you or one of your coworkers, you can walk them through how that will all work.
Absolutely. For the most part, an initial refinance conversation starts with a 5-minute phone call with me. I can review the old file. We can look at rough numbers, rough credit scores, and just kind of price it out, say what the rates are. Here's what you can expect for monthly payment savings, rough estimates. If this looks good, great. Let's open up a new application. I'll get you a legitimate quote today. So it can all happen within the same day, and you can have a new mortgage in 3 weeks.
Right. So really, no, a person doesn't have anything to lose to have a conversation.
Right,
And
absolutely.
so
Zero risk.
similar to what
No risk,
Henry
no
talked about,
obligation.
have a conversation with a financial advisor. You're a financial advisor on the mortgage side. So
Right.
that is really important.
Carol,
Okay.
may I ask a piggyback question on that real quick?
Absolutely. Yeah,
So-
say that again, Robbie.
May I ask a quick piggyback question on that?
Absolutely.
Yeah, so James, do you like this is how I feel, and maybe you can give a better answer to it. Don't you think it's less expensive for them to buy now and refinance than wait for all the buyers to jump back in the pool, which should probably shoot, like, do you know what I mean? Like, if you're gonna refinance, the refinance cost you however much it is. Don't you feel like equity of a housing should shoot up a lot more with the buyers jumping in the pool as the rates go down? So you're better off buying now, refinancing, than waiting and paying a lot more for that same house.
Right. Absolutely. I mean, if you look at what we're expecting future values to do, we're still
Yep.
expecting housing prices to continue to go up. When you add
Yep.
in competition, that just drives prices up. We've seen that. A house goes on the market for 500,000. You have 10 people that want to buy it. It sells for 575 or whatever the numbers are. If you can buy that house now at an 8% rate, and as you're making your payments, your mortgage balance is going down as you're making payments.
Yep.
Now in the spring or next year, this time next year, if you were to buy because rates are lower, well, now that property has gone up in value because that house sold for X amount of dollars. The house next door has now a comparable sale that sold for that much, and now they're going to sell for that much as well. So if you wait to buy, prices are going to continue to go up. So again, to my point before, if you have to wait to buy because you can't afford it, that's great. But if you can buy it now at the rates that they're at, budget more intuitively, and just understand that this isn't a long-term mortgage, you'll be able to refinance that debt with more equity, assuming the values continue to go up. So it will be less expensive in the long term. I mean, look at what real estate's done over the years. The longer you're in, the more equity and the more valuable it is.
James, a piggyback to that I think is important on your comment, because I lived through the financial crisis of 08 and 09 and the housing crisis. You know, interest rates when I bought my first place in Boston in the mid 2000s were in the sixes. So again, you mentioned 7.4 on a conforming 30-year today. We had the largest decline in real estate values, and the place I bought in Charlestown, which still haunts me, only quadrupled in value over that period of time, right? Not to mention that I could have refinanced about 20 times over that period. So I'm not saying
what year, Henry?
This was in 2005, right? So we had the housing crisis. The market fell apart, of course, in the fall of 07. We had 08, 09. My point is, and this is more of a financial planning one, it's really about duration in the asset. You know, if you're going to live in the home, if your buyer's going to be there, it's a function of, can you afford the payments, first and foremost? Secondly, is the opportunity to build equity. Talk to your tax professionals if you file a Schedule A, depending on mortgage size, and you may be deducting interest, particularly a lot of interest in the early stages of the amortization schedule. And if you're in the home for good reasons, because you've talked to James, you've talked to your financial professional, you've talked to Robbie, your realtor, you have a pretty good understanding that it's not necessarily as much of my world about timing. It's about length in the home and ultimately making sure that you've thought broadly about, hey, regardless of what the world's looking like, what are my options going to be during that time? So I think we're all coming from it from the same place, but you know, reminding myself that I never should have sold that place. I bought other real estate that I did well on, but you know, that everybody who bought prior to the housing crisis still made money in Massachusetts years later. And that should tell you that was the most significant cycle, not just in my lifetime, but you'd have to go through Carol's lifetime and those, even when the great Jack Conway was here and the company was created. That was the most significant hit, and values were considerably higher years after it.
Mhm.
Can I add one point to that, Carol? So as you know, again, I'm a big statistics person. So back then we had a huge crash. And the main reason for it were, number one was bad mortgages. And back then housing values went down because we had so many more homes for sale. Back then, during 2008 now, so 2 years after you purchased that, we had 4 million homes for sale, right? Right now we have 1 million homes for sale. Okay. Since then, our population has grown by 34 million people.
Wow.
Okay. And so there's more competition,
Good.
less homes.
Good
And
one.
new homes are being built about 1.4 million per year new homes. So new homes aren't keeping up, and there's just more competition for less homes. So that's why we're not going to see, and this is a question I get all the time too, are we going to see a crash? Is it, or, is this going to be another 2008? Simply put, supply and demand, that's not going to happen.
Absolutely. And, I want to talk about the seller side of this. This is just so much great information. I'd like one of you, or all of you, to share with the listeners where are prices going this year. Did we expected them possibly to level out, maybe go the other way, didn't we? But have they?
And no,
Yeah.
not through. They seem to be holding. They held pretty strong. You didn't see. And maybe and it's always going to happen. Maybe we've had a house, a home overpriced here and there because you have a seller that may want to get a bit aggressive, or there's some circumstances that were like out of our control as far as pricing goes. Okay. There's very few of those that were around, but houses, they're still selling. They're not sitting there. As you can see, our inventory is not building up. Okay. So, and it's crazy, even as the interest rates kept going up and going up, and every day you hear they're going up, and we were getting nothing but bad news, people were still showing up at the doorstep and looking to buy a home.
Because there's other things that cause people to want to buy a home, right?
Yeah.
What are those contributing factors, Robbie? What are things that your buyer clients, they've got to buy now? What are some of the reasons?
They need to move out. Like they've been at home too long with mom and dad. They've been at home too long with roommates. The other thing is rents are so high, like insanely high. Like I'm hearing like 1 and 2 bedroom places on the higher end of $3,100 or $3,300, $36,000 a year to pay to someone else for an apartment. And so I have been hearing a lot more of that now over the last year of like, I'm just tired of giving my landlord rent, okay, or paying rent or giving away my money to rent. And that's why I'm looking for a home. They'd rather pay, we got to the point they were rather paying the 8% interest rate than having to pay out rent.
Yeah. And to Henry's point, you got the tax deduction and some of the other advantages, and you're buying now before the houses continue to go up and the values. And I want to talk about the seller side.
Yep.
So Robbie, let's stay with you for a moment.
Yes.
You've got, I'm sure, a number of sellers that would like to sell their homes. Let's say baby boomer generation want to scale down. Or what about the 40 somethings that have the low interest rates and don't want to sell, but they're bursting at the seams. And so with this decrease in rate, so we went from 8% a couple of weeks ago, right, James? And now we're around 7.4. Will your phone start ringing? Will your sellers say, gee, that was just enough to get me off the fence?
Yeah. I mean, obviously this time of year, Thanksgiving, Christmas, I'm probably not going to hear too much, but I am already hearing in the spring that, hey, we definitely want to sell in the spring. We want to downsize, or we've just had another kid. We're going to need a bigger home. It's interesting. I keep hearing stories, or you read in the media that people don't want to move because of the interest rate. I've not really been having that conversation. I've had 1 or 2 people say, it stinks to give up my rate, but I have to move.
Okay, good.
Okay. It doesn't seem to be affecting people's thought process. And maybe again, it's a supply and demand factor. Maybe again, it's, we have to move because we're bursting at the seams. The other thing is, what is what is pretty wild about all this is they look into getting an addition on their house, the ones that need to make their homes bigger. The building cost is so astronomical. Okay. The builders are so stretched out. Okay. It's also, I don't know if supply and demand is the right thing to use for a builder, but they're so busy, they're going to give you, it's going to end up being a high number because they're stretched out. Okay. And they're also trying to, I think a lot of them got beat up by building costs and how much the materials and stuff were. So they're having to build that in there just because they're afraid they don't know where the building costs are going to go, because some of these projects they're pricing out for, so far out. So what's happening is additions that are being put on a house, people are like, wow, this is crazy. It's going to cost me so much to put an addition on the house. I might as well move. And the thought of an interest rate goes away.
Mm-hmm.
I don't know if that makes sense.
On that, it does make sense. And I want to stick with this point for a minute, because the world has also changed in that people are able to work sometimes more remotely. Does that open the opportunity to maybe extend their search? Have a larger number of towns that looking at, so maybe they can get some affordability that way.
Yeah, 100%. Interesting enough, I met with two different buyers this week that hasn't been looking in a year or 8 months. But both sets of buyers, okay, were working from home, and originally they were looking in more expensive territory because it was close to Boston. Now they've been hearing from work that they're definitely not going to have to go in as much, and they're going further and further south. And they're finding that they are going to get more for the money, and they're enjoying going out there and looking again, because I think they feel settled as well in their job. I was wondering, some people may have been nervous because of, am I going to lose my job? You know what I mean? I hear a recession's coming. Are we not going to be employed anymore? Which I think they're starting to see that that's not happening. So yeah. I'm keeping my job. I'm not going to have to go into Boston. Let's go a little further south and save some more money.
And the statistics, James, you talk about statistics. The statistics really support that. As a company, our footprint is North Shore all the way down to the Cape, out to Metro West and the South Coast, and including the city of Boston. The market and Conway, we're down about 20% over last year. I mean, there's still people buying and selling houses every single day, but it does depend on the region. And the further you get away from the city, the more actually our markets not only are the same as last year, but in some cases more. So so that's interesting. So don't let it go, pass you by, the market, if you're a buyer or seller looking to move. We have about 7 minutes left, and this is such a great topic. James, I want to come back to something. You talked about Fannie Mae and Freddie Mac a little bit, and it sounds like they're making some adjustments to provide some affordability relief to clients. Could you talk to us a little bit about that?
Yeah, absolutely. So on top of a lot of the first-time home buyer programs that have come out over the last year or so for first-time home buyers, with removing loan level pricing adjustments based on area median income, other first-time buyer programs, one of the big changes that's coming out in 4 days is they're reducing the minimum required down payment for multifamily properties for primary residence purchases. So currently, to buy a 2-family, you have to put down at least a minimum of 15%, or in a 3 or 4 unit is 25%. Across the board, they're going to 5%. And the main reason for this, which it's great for us, for the longest time, the last, I'd say 5 or 6 years, the only game in town for a low down payment primary residence mortgage for a multifamily property has been FHA. FHA is a fantastic program. Of course, VA if you qualify. FHA is a fantastic program, but in many cases it won't qualify because of how expensive it's gotten. Now, Fannie Mae reducing that to 5%. The main reason they did this, and it's in the announcement, is to create more affordable rentals. Because if we can turn over more multifamily properties, we're going to have more rentals available for these new landlords that are going to turn these units over and try to rent them out. So we're seeing, at least I know that I've seen the multifamily market, as we've seen higher rates and higher prices, the multifamily market has been hit the most and hurt the most because it's just not moving. So I think that's the main reason for it, to make it more affordable for people to buy these properties and turn over rental units to make it more affordable for rentals.
That's great. You know what I keep on hearing from all of you is opportunity. And there's so much of a silver lining in this market. And when you start to peel away and look at really what's happening, I'm going to go over to Henry next, but I want to ask a question that just came from Susan Sullivan, who works out of Conway, Hingham. She says, my buyers will face a $6,000 penalty if they break their lease to buy now. So they've decided to wait. Is this the right thing to do, or will it benefit them to buy with less of a down payment because of the penalty and the refinance to refinance later? James, I think that's a question for you or Robbie. What do you two think?
I mean, that's $6,000 a lot of money. I don't care who you are, right? So that's a pretty tough one to say, yeah, just eat that $6,000 and then go buy a house. But if you can want to compare it year over year, $6,000 paid to your landlord, your interest rate's 100% or whatever you want to call it. But if you're putting that money, you're paying a penalty, of course. If you buy a property, whatever that property value is, assuming for appreciation of value, your money will go a lot longer if you assume for the appreciation of value. But that's, it's so easy for me to say it's sitting here, right? It's hard for somebody that's going to say, okay, it's going to cost me $6,000 just to be able to leave to get into a property. So I would say that's a judgment call for the client.
Okay, that's good advice.
Can I suggest that? Well, two things. I know, again, back to my buyers that haven't looked in a long time, same thing. They're going to have to pay 2 months up front to get out, but they are enjoying looking with far less people. Like, they couldn't believe when I took them on a showing the other day that, hey, we were actually able to go to a showing and not be in a Congo line walking through in an open house, right? Yeah, it's crazy, right? You're having to make a decision in 15 minutes walking through an open house to buy something. So they're appreciating that. They're fine giving up the 2 months. I guess in some instances, I understand there's multiple offer situations out there still, and some people may think this is tough, but tough to get accepted. But I don't think it is if it's explained properly. Another way to do it is, why not go ahead, make your offer, ask for $6,000 back in closing costs. Okay, so that's freeing up the cash to say, okay, we've paid off that $6,000. Does that make sense, James?
Yeah, it does. And those are
Absolutely,
good
it does.
ideas.
Yeah.
We have, believe it or not, 3 minutes left. And I think we probably could talk about this for another hour or so.
Okay.
But what I'm going to ask each one of you to do is provide our listeners for 1 minute of information that you want to leave with them. Henry, I'm going to start with you.
Yeah, I think the first thing is to think like a contrarian. Opportunities in my world of wealth management, personally and for clients, often happen when the narrative is negative. So don't follow the herd, be contrarian, talk to your counsel, your mortgage brokers, your financial professionals, your realtors, those that have been through cycles, and remind yourself that by the time it's the consensus view, the opportunity is shifted. So that's the first thing. There will be great opportunities to be a bit contrarian. I think I do support the broader narrative that you should be out thinking about executing now, not waiting till the narrative is it's a great time. I think my last thing is make sure that you understand affordability, have the appropriate liquidity, and realize that the cycle is not permanent. Ultimately, the decisions you make in the home have to meet interests that are not always just around the financial end, but about your lifestyle and the things that you're trying to accomplish for you and your family. So I leave you with that, and obviously appreciate the time.
Awesome.
That's fabulous. Thank you, Henry. That I don't follow the herd. Fabulous. Robbie, how about you?
Yeah, so it's almost along the same lines as Henry. Like, okay, just honestly, like, look around you, look at how many people actually want to buy a house, but they're waiting for the interest rates to go down. Okay, remember, you're going to be competing against those people in the future when they come out. Right now, such a great time to buy, because for like the first time in a very, very long time, you may, and I know we've sort of already gone over this, you may have the opportunity to not give away all your rights. You may have the opportunity to do a home inspection now, which you've not been able to do in probably three years, right? You may have the opportunity to make it subject to an appraisal, which, again, we've seen so many offers out there that you've had to waive the appraisal in order to get your offers accepted. The buyers had to consistently and constantly give up their rights to be able to buy a house. You're starting to get some of those rights back right now because you're not competing with so many people. Come next spring or next summer, like I just have a weird feeling when the rates go down and everybody's back in the pool, we're going to be back to that again.
That is a great point. And sellers, Robbie, quick point to sellers. Is it a good time to sell?
Remember, just don't. I guess I get sellers don't get. I don't want to use the word. Just don't ask for too much. You have plenty of equity in your homes. Okay, you know if you're going to ask too much and your house is going to sit there, it's because it's just too high, right? Please, again, you have plenty of equity in your home. Look at it that way. Don't base your number off of a certain number you want to get. That's what you want to do. Fine. Okay, but if you need to sell, you put it out there. It will sell. There's just not enough houses to
rely on an expert. Rely on the expert realtor's advice.
Opinion. Yeah.
Great. Thank you, Robbie. That's fabulous. And James, finally, close us up with some sage advice about interest rates.
Sage advice. So I agree with Henry and Robbie that there's a ton of opportunity in this market. And as rates come down, well, especially in a higher rate market, it's super important to just know your numbers. Know your numbers inside and out. Get the pre-approval conversation going. Even if it's super premature, at least you know your numbers and dumb it down. How much is it going to cost me to purchase the property? What is my payment moving forward? Knowing those numbers is super important, number one. And number two, you can understand your budget so that if you can do it now, great, because of everything we're saying, opportunity, competition, it's all coming. And then my last thought is, if you're ready to do that, get the pre-approval done and be ready to go. Be ready, because when you find a place you love, you have to be able to jump in and act. And we have plenty of opportunities and plenty of programs where you can compete with these cash offers. You can compete when there is a lot of competition to close significantly faster or show your strength as an application. So get the conversation started early, make sure you're ready, and know your numbers.
Fabulous. Henry, Robbie, James, this has been an amazing conversation. Your expertise, your opinions, your perspectives are so very helpful to our realtors and our buyers and sellers. And I'm sure I speak for everybody listening tonight when I say thank you very much for giving us your time and your ideas. So thank you very much. Have a great night, everybody.
Right.
Thank you for joining Conway Conversations. Good evening.